I was reviewing the institutional positioning reports when the most extraordinary revelation in modern precious metals history arrived through encrypted channels that I had never seen activated outside of genuine financial emergencies. A communication so sensitive and so potentially market-moving that it required immediate analysis and verification through multiple independent sources before I could fully comprehend its implications for the silver market dynamics that would unfold when trading resumed on January 2, 2026. Wednesday, January 1st, 2025, 11:47 p.m. Eastern Time, less than 8 hours before the Globex electronic futures platform would reopen to begin the new trading year, when I confirmed that Goldman Sachs had issued internal trading instructions to reverse their entire silver derivative book from net short to net long, representing a position flip valued at approximately $8.2 billion that would fundamentally alter the institutional landscape just as the largest pension fund rebalancing wave in history prepared to deploy unprecedented capital into the best-performing asset class of 2025. The intelligence had originated from a senior risk management source within Goldman's commodities trading division, who reported that the investment bank's quantitative analysis had concluded that their traditional silver suppression strategy was no longer economically viable when confronted by industrial demand patterns that operated according to completely different mathematical principles than historical commodity trading models could accommodate or predict with any degree of accuracy. Goldman's proprietary research had identified that maintaining short positions in silver had become a guaranteed loss scenario, as industrial buyers demonstrated unlimited willingness to pay premium prices for guaranteed supply access, creating market conditions where traditional arbitrage opportunities and volatility-based trading strategies were being overwhelmed by procurement demand that treated current prices as irrelevant compared to the catastrophic costs of production delays caused by material shortages. The position reversal had been implemented gradually throughout December 2025 to avoid market detection while simultaneously allowing the bank to accumulate substantial long exposure before other institutional participants recognized the fundamental shift in market dynamics that made silver short positions potentially catastrophic during periods when supply constraints prevented normal price discovery mechanisms from functioning according to historical patterns. JPMorgan Chase had reportedly implemented similar strategic positioning changes, with their commodities desk receiving authorization to establish a $12.8 billion long position in silver derivatives and physical contracts that represented a complete reversal of their traditional market manipulation role and positioned them to benefit from the industrial procurement wave that was systematically removing available supplies from traditional commodity trading channels. Bank of America's internal analysis had reached identical conclusions, leading to the establishment of a $6.4 billion strategic silver allocation that would be implemented through systematic accumulation during the first quarter of 2026 as institutional buyers competed for diminishing supplies, while industrial demand continued accelerating beyond the capacity of traditional market structures to provide adequate liquidity at stable pricing. Morgan Stanley had authorized their commodities trading desk to implement a $4.7 billion silver procurement program designed to capture the anticipated January effect capital flows, while positioning the bank to benefit from what their quantitative models identified as the highest probability wealth transfer event in modern financial history, driven by mathematical supply shortages that could not be resolved through normal market mechanisms. The collective impact of these institutional position reversals represented approximately $32 billion in combined buying power that would be deployed during the first quarter of 2026, creating unprecedented demand pressure on silver markets that were already operating with critically low inventory levels and constrained supply chains that could not respond quickly enough to prevent explosive price appreciation. The January effect mathematical analysis had revealed that global pension funds, endowments, sovereign wealth funds, and institutional asset managers were contractually obligated to increase their allocations to precious metals by approximately $47 billion during the first quarter of 2026 as part of annual portfolio rebalancing requirements that prioritized the best-performing asset classes from the previous year while reducing exposure to underperforming categories. Silver's 2025 performance had exceeded all other major asset classes with gains approaching 340%, making it mathematically impossible for institutional allocation committees to avoid substantial silver exposure during 2026 portfolio construction without violating their fiduciary obligations to maximize returns through systematic exposure to demonstrated performance leadership across all available investment categories. CalPERS, the California Public Employees Retirement System with $485 billion in assets under management, had scheduled the implementation of a $14.2 billion precious metals allocation increase during January 2026, with approximately 60% designated for silver exposure through various physical and derivative instruments that would provide direct participation in continued industrial demand growth while offering portfolio diversification during periods of financial market uncertainty. The Teacher Retirement System of Texas had announced similar allocation adjustments, designating $8.7 billion for strategic metals investments during the first quarter of 2026, representing institutional buying power that could absorb substantial silver quantities while providing price support during any temporary corrections that might result from normal market volatility or coordinated manipulation attempts by remaining short sellers. The Norway Government Pension Fund Global had indicated their intention to increase commodity exposure by $11.5 billion during 2026, with silver receiving priority consideration due to its essential role in renewable energy infrastructure that aligned with their environmental sustainability investment criteria, while providing superior return characteristics compared to traditional commodity investments during periods of structural supply shortages. The Canada Pension Plan Investment Board had established a $6.8 billion strategic metals allocation that would be implemented during the first half of 2026, representing institutional procurement demand that would likely compete directly with industrial buyers for available silver supplies that were already constrained by existing demand from technology manufacturers and renewable energy developers. The collective institutional buying power represented by these mandatory allocation increases totaled approximately $47 billion in new capital that would systematically enter silver markets during the first quarter of 2026, creating unprecedented demand pressure during the exact period when industrial consumption was reaching historical peak levels due to expanded production schedules for electric vehicles, solar panels, and advanced electronics requiring substantial silver quantities. The physical market analysis had revealed catastrophic inventory depletion across all major distribution channels, with retail precious metals dealers reporting that their wholesale suppliers were either completely sold out or demanding immediate payment at prices that exceeded historical premium levels by 200 to 300%, creating impossible economic conditions for normal business operations. APMEX, JM Bullion, SD Bullion, and Provident Metals had collectively implemented allocation protocols that limited individual customer purchases while extending delivery timeframes to 16-20 weeks as they attempted to secure replacement inventory through alternative supply channels that were proving increasingly expensive and unreliable due to competition from Asian industrial buyers offering superior pricing and guaranteed payment terms. The premium explosion had reached unprecedented levels as physical silver commanded prices ranging from $95 to $105 per ounce, while COMEX futures continued trading near $78, creating an arbitrage gap that should have attracted massive professional trading interest but was proving impossible to exploit due to logistics constraints and inventory availability issues that prevented normal arbitrage mechanisms from functioning effectively. European precious metals markets had exhibited similar stress patterns as London-based dealers reported that their traditional supplier networks were prioritizing Asian customers offering premium payments and guaranteed offtake volumes rather than maintaining existing relationships with European distributors who operated under traditional pricing structures that had become economically unviable given current market conditions. Swiss refineries had implemented strategic allocation protocols that prioritized existing industrial supply contracts over new customer commitments, effectively closing their order books to new business while focusing their limited production capacity on fulfilling existing obligations to technology manufacturers who required guaranteed silver delivery for critical production schedules that could not be delayed without catastrophic economic consequences. The industrial procurement acceleration had reached panic levels as technology companies recognized that silver availability was becoming more critical than silver pricing for maintaining production schedules that generated hundreds of billions in revenue while requiring guaranteed access to essential materials regardless of short-term market volatility or supply chain disruptions. Tesla's Strategic Materials division had reportedly increased their silver acquisition target to $4.8 billion for 2026, representing procurement requirements that would absorb approximately 60 million ounces annually through direct mining relationships that bypass traditional commodity markets while providing supply security for their expanding electric vehicle production and energy storage manufacturing operations. Apple's component procurement strategy had allocated $3.2 billion specifically for silver acquisition during 2026, reflecting their assessment that secure silver supplies had become essential for maintaining iPhone production, data center operations, and renewable energy infrastructure that required high-performance electrical components manufactured with precious metals for optimal conductivity and reliability characteristics. Samsung Electronics had established a comprehensive strategic materials procurement program with $5.1 billion designated for silver acquisition, representing their largest ever commitment to securing critical technology materials for semiconductor manufacturing, display production, and battery development that required substantial silver quantities for optimal performance across all product categories. Microsoft Corporation had surprised industry observers by announcing a $2.7 billion strategic metals procurement program focused on securing silver supplies for their expanding data center infrastructure, cloud computing hardware development, and artificial intelligence system manufacturing that required sophisticated electronic components incorporating precious metals for optimal electrical performance and thermal management capabilities. The macroeconomic backdrop had created additional supportive factors for precious metals. Demand as concerns about federal debt sustainability, currency debasement, and financial system stability drove institutional investors toward hard assets that provided inflation protection and portfolio diversification during periods of monetary policy, uncertainty, and geopolitical tension. The approaching debt ceiling crisis had generated institutional hedging demand for precious metals, as investment managers recognized that potential government funding disruptions could create financial market volatility that would drive capital flows toward assets with intrinsic value rather than financial instruments dependent on government stability and currency confidence. The BRICS currency development had created additional uncertainty about dollar hegemony and international trade settlement mechanisms, encouraging institutional diversification into precious metals that could maintain value regardless of changes in global monetary system architecture or shifts in international economic power structures that might disadvantage dollar-denominated assets. The Federal Reserve's policy framework had created inflationary pressures through continued monetary accommodation, while simultaneously constraining their ability to raise interest rates due to government debt service requirements, creating conditions where real interest rates remained negative and drove institutional capital toward assets that could preserve purchasing power during extended periods of currency debasement. The European Central Bank's negative interest rate policies had generated similar capital flight toward precious metals as institutional investors sought alternatives to government bonds that provided negative real returns, while exposing portfolios to currency risks and sovereign debt sustainability concerns that could generate substantial losses during financial system stress periods. The Bank of Japan's unlimited monetary accommodation had created massive liquidity flows that were seeking higher returns through alternative investments, including precious metals that offered superior risk-adjusted performance compared to traditional fixed income instruments that provided inadequate compensation for inflation and currency debasement risks. The Chinese central bank's strategic metals accumulation program had removed substantial precious metal supplies from global markets while simultaneously creating competitive bidding pressure that drove prices higher and encouraged other institutional buyers to accelerate their own acquisition programs before supply constraints made essential materials unavailable at any reasonable pricing. The countdown to January's second market opening had created extraordinary tension as institutional algorithms prepared to execute massive buy orders, while physical markets operated with critically low inventory levels that could not accommodate sudden demand surges without explosive price appreciation that could trigger additional buying interest from momentum-based investment strategies. The algorithmic trading systems had been programmed throughout December 2025 with specific execution parameters designed to implement institutional allocation increases through systematic purchasing that would minimize market impact while ensuring adequate position accumulation, before other participants recognized the magnitude of institutional demand that would characterize the first quarter of 2026 silver market dynamics. BlackRock's Aladdin risk management system had reportedly scheduled the deployment of $18.7 billion in precious metals allocations beginning at 6 p.m. Eastern Time on January 1st, when the Globex platform reopened for the new trading year, representing systematic buying power that would be implemented through sophisticated algorithms designed to optimize execution while avoiding price volatility that could attract additional competition for available supplies. Vanguard Group's institutional trading desk had prepared similar deployment strategies for their $12.4 billion silver allocation increase, utilizing advanced execution algorithms that would systematically accumulate positions across multiple trading venues while monitoring market depth and liquidity conditions to ensure optimal pricing during the initial phases of institutional capital deployment. State Street Global Advisors had implemented comprehensive silver acquisition protocols that would deploy $8.9 billion through coordinated buying programs designed to capture institutional allocation requirements while minimizing market disruption through careful timing and sophisticated order management that balanced execution speed with price optimization during periods of anticipated volatility. The collective algorithmic buying pressure represented approximately $40 billion in systematically managed capital that would begin executing simultaneously when markets reopened, creating unprecedented demand concentration during the exact period when physical inventory constraints were most severe and supply chain disruptions were preventing normal market-making activities from providing adequate liquidity buffers. The technical infrastructure supporting this massive capital deployment had been tested extensively during December 2025 to ensure that execution systems could handle unprecedented order volumes without creating operational delays or settlement failures that could disrupt normal market functioning during the most critical trading period of the new year. The Globex electronic platform would reopen at 6 p.m. Eastern Time on January 1st, providing the first opportunity for institutional capital to begin implementation of 2026 allocation strategies, while simultaneously testing the market's capacity to absorb unprecedented buying pressure without triggering circuit breakers or volatility halts that could disrupt normal trading operations. The Chicago Mercantile Exchange had implemented enhanced monitoring protocols and increased margin requirements in anticipation of extraordinary volatility during the January 2nd opening session, recognizing that institutional capital deployment combined with continued supply constraints could generate price movements that exceeded normal risk management parameters and required additional safeguards to maintain orderly market operations. The London Metals Exchange had coordinated with American trading platforms to ensure adequate liquidity provision during anticipated volatility periods while implementing emergency procedures that could temporarily halt trading if price movements exceeded predetermined thresholds designed to prevent market manipulation or excessive speculation during periods of fundamental supply and demand imbalances. The gap-up probability analysis suggested that silver futures could open 8 to 12% higher than December 31st, closing prices due to accumulated institutional buying interest, combined with continued inventory shortages that had persisted throughout the holiday trading suspension, while industrial procurement requirements continued generating demand pressure that could not be satisfied through available supply channels. The pre-market positioning analysis had revealed that systematic funds, commodity trading advisors, and algorithmic momentum strategies had collectively reduced their silver exposure during December 2025 in anticipation of year-end rebalancing volatility, creating substantial underexposure that would need to be corrected through aggressive buying once 2026 allocation targets were established and institutional capital deployment began in earnest. The options market positioning had created additional explosive potential as massive call option concentrations at $80, $85, and $90 strike prices would require systematic hedging by market makers if the underlying futures contracts opened significantly higher than December closing levels, potentially creating gamma squeezes that could amplify initial price moves through forced covering activity by institutions that had sold these options. The international market coordination had become critical as Asian trading platforms prepared for unprecedented silver demand from Western institutional buyers, while simultaneously accommodating continued industrial procurement by Chinese technology companies, whose strategic material acquisition programs operated independently of normal market mechanisms and prioritized supply security over cost optimization considerations. The Shanghai Gold Exchange had implemented enhanced trading protocols and expanded delivery capacity in anticipation of increased international participation, while maintaining priority access for domestic industrial buyers whose procurement requirements had acquired national economic security implications that transcended normal commercial considerations and required government support for strategic material acquisition programs. The Singapore Exchange had positioned itself as a critical intermediary for international silver trading by expanding their precious metals trading platform and establishing additional vault facilities that could accommodate increased physical delivery requirements from institutional investors seeking direct exposure to silver price appreciation through ownership of deliverable contracts rather than purely financial instruments. The technical analysis framework had become increasingly irrelevant as traditional chart patterns and resistance levels were being overwhelmed by industrial procurement demand that operated according to strategic necessity rather than normal profit optimization considerations that characterized historical commodity trading behavior patterns. The first quarter 2026 price target analysis had identified $125–140 per ounce as a reasonable expectation based on institutional capital flows, industrial demand acceleration, and supply constraints that could not be resolved quickly enough to prevent substantial price appreciation during the period when pension fund allocation increases would compete with technology company procurement for diminishing available supplies. The gold-to-silver ratio had reached historically attractive levels for silver investors, with current ratios near 38.1, suggesting substantial additional appreciation potential as silver's industrial demand characteristics provided superior fundamental support compared to gold's traditional monetary role during periods when industrial necessity overwhelmed financial market speculation. The exit strategy framework required careful monitoring of the gold-to-silver ratio convergence toward historical extremes near 15.1 that would indicate silver had become temporarily overvalued relative to gold and might warrant tactical rebalancing toward the more stable monetary metal while maintaining long-term precious metals exposure during continued financial system uncertainty. The wealth preservation implications were extraordinary for investors who recognized that silver's transition from commodity to strategic material had created the most significant investment opportunity in modern history, where industrial necessity would drive pricing far beyond levels justified by traditional commodity analysis, while providing portfolio protection during currency debasement and financial system instability. The new trading year would begin in less than 8 hours with institutional positioning completely reversed from historical patterns, creating unprecedented conditions where traditional manipulation strategies had been abandoned in favor of strategic accumulation during the most significant commodity market transformation in modern financial history. The institutional capital deployment beginning January 2nd would establish new paradigms where industrial demand and strategic necessity would determine pricing rather than financial speculation, creating sustainable appreciation trends as technology advancement accelerated silver consumption beyond traditional supply capacity. The countdown to market opening marked the beginning of the greatest wealth transfer event in modern commodity history, as institutional recognition of silver's strategic importance finally aligned with industrial reality that had been developing while financial markets operated according to obsolete supply and demand assumptions.